The E-mini is opening unchanged. I think it's overbought. On a weekly chart, we have 6 consecutive bull bars, and several of them are very big, so that's extreme. The bulls are hoping that we break above the October, November, December triple top, but I think we're probably going to pull back this week or next week for 2 to 3 weeks, maybe more. We have a doji bar 2 weeks ago for a buy signal. It's a weak buy signal. Typically, either the entry bar is not good or the follow-through bar is not good. The entry bar last week is good, and therefore you have to assume something will be wrong with the follow-through bar, which is this week's bar on the weekly chart. Daily chart, a lot of bars up. I've been talking about this as a likely target or a possible target from the reversal up, but I did not think we would go straight up to the October, November, December highs. I thought this was the sell zone. The bulls who bought would be happy to be able to get out break even after the crash, and the bulls who bought down here will look to take profits, a buy climax, and the bears will start to sell. So I think we're going to pull back for 2 or 3 weeks. I expect we'll come down to the February low from last year at some point in the next month or so. We had these 2 big bull bars last week, and that usually is enough to get a small second leg up. However, I think there's a 60% chance that either Friday's high will be the start of the pullback, or we'll get one more new high, and that'll be the start of the pullback. So this is a good area for traders to buy puts, looking for a test at least down to here. Can we keep going up here? Sure, it's just not likely. This is a potential final flag, a trading range late in a bull trend. We're in the middle of last year's trading range. That tends to limit how far up or down we'll go. Last year we were in a range all year. We were then in a range here for a couple of months, and we're back into the middle of both. Therefore, I think we'll start to pull back this week. 60-minute chart, possible final flag, trading range late in a bull trend, mostly horizontal. You can call it a triangle if you want, 1, 2, 3. So I think we'll come down here. So maybe a 50, 60 point pullback, maybe more. This looks like a bull flag, so we may get one more push up on the 60-minute chart. 5-minute chart, sideways for 2 days, pretty much mostly sideways. We rallied here, but then sideways. The bulls have a double bottom. The bears want a head and shoulders top. Left shoulder, head, right shoulder. So that's what the market's deciding. Does it go up for another day or two and then begin to correct, or does the correction begin today? It's more likely after those 2 big bars last week that we're going up higher, even if we go below Friday's low. Friday it's a sell signal. We have a potential final flag. We have a buy climax. We're at major resistance, and it's a pause bar closing around its middle. So theoretically, we could go below Friday's low and begin a reversal down here. Big tail below, not a good sell signal bar yet. It reversed down. So, we could start the swing down, but I think more likely we'll get one more new high. Friday, it's a weak sell signal bar. We may have to go below Friday's low to see what's there. It's a credible sell signal, so we may have to go today below Friday's low to trigger the sell. There probably will be more buyers than sellers below Friday's low. And what about Friday's high? If we go above Friday's high, what will happen? Well, look at it. It's a doji bar on the daily chart, and therefore there are probably sellers above Friday's high. So probably buyers below, sellers above. That increases the chances that the 2-day trading range will continue. What do you do here? You buy the 81 low. We finished Friday, always in long, barely, but we're in the middle of Friday's range. We opened almost exactly, looks like we did open exactly at Friday's close. So a pretty much neutral start to the day. Always in long, but not a good buy signal bar one. It's like on Friday, we had a high one bull flag, but a bear body did not go up very far. So this day might have a lot of two-sided trading again, like Friday. So a lot of limit order trading, a lot of reversals after a few bars. I'll be speaking in Orlando on Friday, and I fly out there on Thursday, so I will not be here Thursday and Friday this week. 5 or 6 bar tight trading range, bear bar tail below, so sellers below. High one bull flag, but bear bar probably bear bar tail below, probably buyers below. High one bull flag, but bear bar sellers above. I think we're probably going to go below Friday's low to see what's there. The daily chart is overbought, and Friday is a possible sell signal bar. Limit order bulls probably will buy one low, buy a 78 low, buy more 1 or 2 points lower. Suppose we get consecutive bear bars, and let's say 2 closes on its low. That would make it always in short, and it would increase the chance that we're going down to Friday's low. But 2-day trading range, not a very strong seller close setup. Better to wait. We get information here over the next few minutes. Will the limit order bulls make money? That reduces, if they do, that reduces the chances of a bear trend. You can see the ones who bought the 78 low and more 1 point lower have made money. The ones who bought the 1 low have not yet made money. For the bulls, we have a bear trend, a bull breakout. They want a higher low major trend reversal, double bottom 78, and higher low major trend reversal. And the bears are hoping that this bear channel is now simply a wider, broader bear channel. We finished Friday with a wedge, 1, 2, 3, 4, 1, 2, 3. Expect a couple legs sideways to down. It might be 1 pullback 2 or 1 pullback 2. Bulls trying to create a credible buy signal bar, but after 2 decent bear bodies, a lot of bulls will wait and not buy above 3. You can see the limit order bulls are trying to get it 1 tick above that 1 low. And the bears are trying to stop them. The bears want to go directly below Friday's low. How good a bull bar do the bulls need to buy above 3? After 2 bear bars, unless the context is especially strong, it's usually better to wait. Okay, the bulls get up to the 1 low. Can I get 1 tick above? If the bulls do not get above 1, bears will be more willing to sell below 3, especially if 3 closes near its low. It's taking a lot of time to tell us whether or not it can get above the 1 low. Looks like trading range price action. The bears are unable to drive it down, and bulls are unable to reverse it up. 100, big round number, has been important over the past week. Lots of reversals over the past few days. That's the sell signal, but near the bottom of yesterday's range. Is the probability high enough for a scalp? Might not be. So selling below 3 is more of a swing trade, looking for a break below yesterday's low, and buying above 3 with 3 consecutive bear bars. Probably sellers above 3, sellers above 2, sellers above 1. So not a strong buy, but you can see the bulls not only prevented the bears from triggering the sell below 3, they got the market to go above 1. So the limit order bulls made money buying below 1 and below 78. Weakens the bear case despite the 3 bear bars. When do the stop entry bulls buy? They have a double bottom 78. They have a higher low major trend reversal. But there are 3 consecutive bear bars. So most bulls would like to see at least a couple consecutive bull bars before buying with a stop. New high of the day. Can you buy on a stop above 3? Higher low major trend reversal. With the 3 consecutive bear bars and the 10 bar tight trading range, I think that lowers the probability. So probably better to wait for consecutive bull bars. A lot of traders will simply buy the new high, but no, I would not. The bears, they're selling here. They're selling the new high. They'll sell more higher, looking for at least a 1 point scalp, just like the bulls bought the 1 low. Good bar for the bulls, but the probability is not as high as I think a lot of traders would like. They'd like to see consecutive good bull bars. We had a spike and channel down Friday, spike, pullback, channel, and the top of the channel is a magnet. We had bulls buying here, hoping for a reversal up, and they bought more lower. And usually the market gets back up to their first buy, and a lot of times it pulls back down there because these bulls are happy to be able to avoid a loss, and they sell out of their longs. So there's some supply up here. Bears unable to get below the Globex low, and the bulls will now try to get above the Globex high. It's very common for the market to test either the Globex high or low, get near it, and then reverse and test the other end. Suppose we get a bear bar, bar 4, and bar 5. What do you do? If it's a big bear bar, it would be a swing short. We got a couple legs up from Friday's sell climax. 1 pullback, 2. The bears would be a bigger wedge. 1, 2, 3. Expanding triangle. 76, 78, and 3 bear bars. Bears made money selling above 1. They made money selling above 78. So we still have limit order traders making money on bar 2 and then bar 4 and 5. Can we come down to the 3 high? 3 is not a good looking buy signal bar, despite a higher low major trend reversal and a double bottom. So we make them down here to the 3 high. Limit order bears sell the 3 high, they sell more higher, expecting a bad buy signal bar. We'll come back and test the top of the buy signal bar, the bar 3 high. Bulls are trying hard to get consecutive bull bars closing on their highs. They're hoping to convince traders that it's a buy the closed rally. With all of the reversals Friday, traders expect reversals today. And we're also in the middle Friday's range. Friday's a doji bar. And as I said, I think there's an increased chance that this week will be a bear bar on the weekly chart. because 6 consecutive bull bars is extreme. So Friday's close, I bet, will be below today's open, and that will create a bear body on the weekly chart. The minimum the bears want is a 1-tick bear body. The minimum the bulls want is anything other than a 1-tick bull body, and that would flip it to always in long. So for me, that is always in long, but not strongly bullish. Limit order bears made money despite the surprise bar up. We have a magnet 3 high, so we'll probably get down there, whether or not we go higher. But 5, while not a bear body, a lot of bulls are not buying the market. Limit order bulls might buy 5 low, might buy 3 high, and the bears are trying to get down to the 3 high. Still no convincing trend yet. Traders are still uncertain, which means they're still fading, still selling above, buying below, and taking quick profits. After the first bar, we reversed up and we reversed down, so breakout mode. But not a lot of traders are going to sell below 2 or buy above 5, even though it's breakout mode. For the bulls, 6 is a high 1 bull flag, but top of an expanding triangle trading range in the middle of yesterday's trading range. So not good stop entry trading, selling above, not good stop entry trading, selling below 5 or buying above 6, trying to get below Friday's low. You can see some bears sold on the stop below 2. We just got below the Globex low. So that takes care of that magnet. I always pay attention to the Globex high and low. I bought puts last week. I have a small position. If it goes, my thought was if it went higher, if we went above last week's high, I would buy more. And if it just goes down 50 points or so over the next week, I'll just take the profits. I've been thinking about buying or shorting crude oil, buying crude oil puts or shorting crude oil. And I really should have done it on Friday. I should have placed a limit order to sell around Friday's close. I did not. Now it's still breakout mode, so you'll still have some bulls betting against the breakout and buying with 2 low and scaling in lower. I would not do it. Is it sell the close here? I think the math is bad. If you sell below 7, your stop is up here, so the risk is big. And look at the chart. For 2 days, since Thursday, we've been going sideways. And selling at the bottom, hoping for a bear breakout, or buying at the top, hoping for a bull breakout, is a low probability bet. And that's true even when the sell-off is strong or the rally is strong. Reversals are more common than breakouts. And I think that makes the math bad to sell below 7. You have to wait for more of a breakout, more bear bars. Bulls, again, trying to get above the breakout point, the 2 low, and the bears are trying to trap them. They're trying to get below Friday's low to see what's there. We also have the close of 2017. I don't have it drawn on the weekly chart, but the close of 2017 was a magnet all right here. It was a magnet all last year. We reversed around it repeatedly. Remember, this week is probably going to be a bear bar on the weekly chart, at least a small one, after 6 bull bars up to the middle of a trading range. Probably back to always in short, but traders are hesitant to sell at the bottom of anything. Friday, we sold off for 70 bars, yet bulls kept making money buying at the low. traders are afraid to sell low. Expanding triangle top, 1, 2, 3. Now expanding triangle bottom. 5 of the first 7 bars are pretty good bear bars. I think that lowers the probability that bulls will buy above 8. We had a surprise bar up 5, but a magnet at the 3 high after 3 bear bars. And now we have a surprise bar down 7, and we have a lot of bear bars, and we have a magnet below Friday's low, and we also have that close in 2017. So our traders going to buy above 8. If it's an extremely big bull bar, they will, but otherwise they'll look to sell a pullback, maybe a low 1 or a low 2. 8 is a pullback from 7. You can see the limit order bulls made their money. Did they? No, they did not. Had to go up one more tick. But anyway, it's a pullback, so it's a low 1 sell signal bar. But at the bottom of a 2-day, now 3-day trading range, not a great stop entry sell. It's important for the bulls to get one more tick up and get 1 tick above the 2 low. It's important because it affects the opinion of traders about the rest of the day. Can the bulls keep making money even with lots of big bear bars? If so, today will probably be more of a trading range day. If, on the other hand, they're trapped and cannot make money buying below 2 or buying the 2 low and buying lower, that would increase the chances of a bear trend day. Okay, just went above the 2 low, so it reduces the chances of a big bear trend day. Bulls made money in a bear breakout, right? That is more trading range behavior than trending behavior. For the bulls, a double bottom 2, so theoretically a possible low of the day, but most bulls are not going to buy above 8. A surprise bar down 7 consecutive bear bars, probably going at least a little lower. But location is really bad for the bears. Most traders better off waiting. Selling near the bottom, buying near the top. So far, not a good strategy. That's the buy, but I would not take it. Bull body, good. Double bottom 2, good. Higher low major trend reversal after yesterday's bear trend, good. But too many bear bars and a couple big magnets below. And for the bears, a low 1 short, but you're selling below a bull bar in a market that has been reversing up below things today and on Friday. This might be similar to this. We may have to go sideways and get a low 2 or a wedge before the bears will sell again. Bears might sell above 8, like 1 point above 8. They might sell at the moving average, and they might sell 50% pullback. 5, not a good sell signal bar, despite the expanding triangle. So it's possible we have to go all the way up to the 5 low, where the limit order bulls will try to get out. All the way back to the 5 low. So the bulls have bought 5 and use a very wide stop. We're able to avoid a loss. Trading range trading. Consecutive bull bars, but I think the math is difficult. The bars are big, so the risk is big, and we're getting very abrupt big reversals, and therefore the probability of a trend is not very big yet. Can you trade every reversal? Can you sell below 10? Buying above 3, profitable, selling below 5, buying above 8. So traders that are making money with reversals all day, I think the best choice is wait. It has still not yet decided on any direction. What about buying above 5? That would be a second breakout above 1 and a second breakout above 78. That would have higher probability for the bulls, but it's still, I think the math is still bad. Expanding triangle, up and down and up and down and up and down. Eventually the market stops doing the expanding triangle reversals, and it moves on to something else, either a trend or a trading range. For the bears, 10, a pullback from the 7, break to a new low. But with all the reversals, the probabilities are lower than what traders want. The bulls see 10 as a pullback from the 9 bull trend, early bull trend, and the bears see 10 as a pullback in a bear channel. So bear new low, pullback, just like Friday kept making lower highs despite sharp rallies. Any one of these reversals is a reasonable swing, and then you just get out. So theoretically, there's some bears that sold below 6, get out above 8. Bulls bought above 8, they'll get out below 10. But I still think it's better to wait until we start going consistently one way up or down. Sell signal, but might be more buyers than sellers below 10. The bulls hope 10.11 is a pullback from 9, and the bears see 9 as a pullback from 6.7. Middle of a trading range open. Breakout mode, whenever the market is in breakout mode, traders expect a successful breakout up or down and then a measured move. You can argue that we've already broken below 2, and therefore the measured move is based upon that. And if we break above this, then the measured move would be based upon this low to that high. Reversals, we're winding up into a contracting triangle. We have an expanding triangle here, and we may be getting a contracting triangle here. And we were getting lower lows, lower highs. Now we might be getting lower highs and higher lows. In the old days, that kind of a pattern was called a diamond pattern, expanding triangle followed by a contracting triangle. It doesn't really mean anything. We already know we're in breakout mode. Bulls, theoretically, they might be still long, stop below 8. Bears, theoretically, right now, if they're short, their stop is probably above 10. Bulls hoping for another good buy signal bar, and the bears are hoping that we've begun a bear trend. I think the odds are we're going below Friday's low. It's a sell signal bar on the daily chart. Also, even though it doesn't look bearish, Friday closed one tick below its open, and that created a tiny bear body on the daily chart. And when that happened, when 81 on Friday closed one tick below the open, I thought the market was sending a message that we probably were going to go below Friday's high at some point today, Monday. I don't know if I said that correctly. I thought by Friday, having a bear body, the market was telling us we probably had to go below Friday's low today. This is the end of the first hour, and so far, an outside down bear bar, but in a 2-day tight trading range. So not helpful in terms of predicting the direction of the breakout. It's just a continuation of the tight trading range. Bulls trying to get outside up. You can see they bought the 14 low, trying to break above. They really need to break above 5. And bears, they're probably selling with limit orders, trying to create a double top bear flag 10. So for the bears, they have a bear trend 6-7, and they view this as a double top bear flag. But if the bulls get 2 ticks above 10, that would greatly reduce the chances of the double top bear flag. 15-minute chart, we have a micro double bottom and a pretty good bull bar. So high 1 buy here, high 1 2 buy here. So that's buying above bar 15. It's still, you can see traders are hesitant to buy high. They did not buy above 9, even though big bull bar closing on is high, and same with 13. That triggers the 15-minute buy signal. You can see on the Globex chart, but tight trading range, that lowers the probability for stop order traders. Not good enough for a scalp because the risk is big and the probability is not as high as scalpers want. But for a swing trade, it's an okay buy. Most traders, should they take the buy? I think it's still better to wait. I think we have still not clearly begun a trend. Breakout mode, bulls want to get above 5, and they're hoping for a swing up. It's still not clearly about to break out, so the math is still not all that good, buying in closes and buying above bars. And for the bears, can you sell? Now we have 4 consecutive bull bars. Yes, we're at the top of a trading range, but 4 consecutive bull bars. Most bears are not going to sell below 16 or 17. Best choice, wait. For the bears, it's a double top 10, double top 5, a spike and channel rally, spike, pullback, channel. But it's also 4 consecutive bull bars, so not a high probability sell. For the bulls, they're hoping this is the start of a small pullback bull trend, but it's similar to this yesterday. Did not last all day. So, not good trading. Selling below 18, it's a swing, low probability. Buying above 17, it's a swing, low probability. So traders are stuck waiting for a better sell setup at the top of the range, or a better buy setup at the bottom, or waiting for a breakout. Simply selling right here at the market and putting a stop above 5. That's one of those low risk, low probability trades. The math is okay, but you lose most of the time. Right? We're probably going above 5. So if you were to sell here, 1 tick below the 5 high, and put a stop 1 tick above, you're risking 2 ticks, hoping to make 10 or more points. You'll probably lose. We're probably going above 5. Still might be forming a bigger expanding triangle. We have a high, another one, another one, another one. Bulls trying to get a breakout. It's a credible buy setup. It's a breakout of the 18-bar range. When you have a breakout of the 18-bar range, in general, 90% chance you're not going to break below the bottom of the range. Here, the range is small. We're still in breakout mode, so maybe 80% chance we've seen the low of the day. If the breakout is going to fail, it typically fails within a bar or two of breaking out. So here we're breaking out on 19. If this breakout is going to fail, we'll probably get the reversal on 20 or 21. The bulls have a breakout here. What they need is follow through. If they get it, then we've probably seen the low of the day. If a breakout of an 18-bar range is going to fail, it normally fails very quickly. So here we broke out on bar, whatever this is, bar 20, and reversed down the very next bar. Broke out above the 18-bar range, and a few bars later, reversed. Very strong rally. The blue box is the first 18 bars, broke out, reversed. The bigger the breakout, this is a big breakout, the bigger the breakout, the more likely it's going to be successful. So right now, it looks like we're going to get at least a small second leg up. So traders are buying the market, buying closes, betting that we're going at least a little higher. Will we get a measure move up to yesterday's high? Don't know. But right now, this is increasing the chances of at least somewhat higher prices. Can it still be a failed breakout? Normally, if you're going to get a failed breakout right away like this from the 18 bar range, the breakout bar is not big like that. I have several examples of failures. Here we have a doji bar, doji bars, small bull bar, a lot of doji bars, doji bar. Here we got a big bull bar and big bear bar. So here's an example. When you have a big bull bar and a reversal, what's different is this big bull bar did not go far above the 18 bar range. Today we went far above the 18 bar range, and therefore I think more likely buyers not far below 20 and probably not worth shorting below 20. A lot of times you get a breakout above the 18 bar range and you end up going sideways for a lot of bars. This is what the bulls want. They want it just to go straight up. But a lot of times, instead of going straight up, it breaks above and then does this. Here we're going down for 10 bars. So this might be like today. But breaking above the 18 bar range is important. Here, breakout sideways. Breakout sideways. So that's what we might be doing. I think that is much more likely than the breakout failing and the market getting back down to the low of the day. What do the bulls do with 20? I'd get out of longs and wait to buy again. And for the bears, I'd wait for at least a micro double top to sell, or for 3 big bear bars, or 3 consecutive decent bear bars closing on their lows. Everybody wants things to be clear, but it's not going to happen. Bears who sold the 5 high have made money. So here we have 7 bars without a bear body and a very big bull breakout bar. Yet bears were willing to sell the 5 high and sell more higher because they were confident this was not going to be the start of a big bull trend. And they're right. So the bears have failed to break out a bigger expanding triangle. Now we went up and then 2. So 1, 2, 3, 4, 5, 6, 7 legs. A bear bar, but not closing on its low. And it follows 7 bull bars, or 7 bars without a bear body. Probably buyers not too far below. Stop for the bulls. Unfortunately, it's all the way down here. When you get a breakout of the 18 bar range like this, 90% chance you're either in a bull trend or a trading range. 10% chance you're going to break below the low of the day. As I said, because the initial range was relatively small, maybe 20% chance we break below the low of the day. If we start to sell off, then 20% becomes 30, 40, 50, 60% chance, 80% chance we're going to break below the low of the day. But right now it's only 20% chance. For the bulls, 20 is a pullback from the breakout above the opening range, and therefore it's a buy signal bar, a high 1 buy signal bar. We have a potential gap, 20 low, 18 high. So bulls might want to measure move up from there, or possibly from the entire 18 bar range, which would be there. In either case, the bulls would like to get above Friday's high. But I don't think we're going to go much higher this week, despite 6 consecutive bull bars on the weekly chart. We're in the sell zone on the daily chart, the December 12th crash high. Bulls want to get up here. They want to break above the October, November, December triple top. And we probably will at some point in the next several months, but I think we're going to pull back to the February low from last year. before we do. Bulls high one above 20, high one above 21, but pretty good bear bar 20, making it a couple small legs down, may test the 19 buy climax low and the moving average. So bulls buying above 21, I think need to stop all the way down here, not just below 21. We may get a couple legs sideways to down, make it a wedge bull flag. Because of the weak follow through, the expanding triangle, and the 3-day tight trading range, I think the odds are against a big bull trend today. And we may do, like in the examples that I showed, we may go sideways a lot for the next hour or two. This may be our future. By the close, bulls 19, disappointed 20. Some of them will sell out of their lungs now that we're back up to that 19 close and 19 high. So the bears are hoping for a micro double top and then a reversal down, forcing the bulls to give up, but the odds are against it. The odds are either bulls will not sell out of their longs, or they'll look to buy more after a 2 or 3 leg pullback down to the moving average. So you get some swing bears willing to sell right here at the 19 close, betting that the bulls will be disappointed by 20 and that they'll sell out of their longs on the test of the 19 close. But most bulls, I think, will hold and just use a wide stop. The bulls who are not scalping will probably hold and use a wide stop. Bears, if we reverse here, it'll be a micro double top. That would be a higher probability sell, but still probably only a minor reversal. You'll have some bears selling above 20. They know bears made money even selling above 5. With that big bull bar, the bears made money. So they're going to sell above above 20. We went below the Globex range, and now we're above the Globex range. Bears want a second sell signal for the expanding triangle. That a sell signal of 20 did not trigger. Some bears will sell 20 high, and some will sell 23 low if it's a decent bear bar. Decent bear bar, 3 or 4 tick body closing on its low. But look at the bull's channel, unlikely to go straight down. I said that on Friday, but it happened. If you get 3 consecutive bear bars, you'll get traders selling closes, betting that will go lower. But more likely, you'll get a bear bar or 2 and will go sideways, maybe a double bottom 20, 21. Six ticks above 21 and a pullback. It tells you that a lot of the bulls scalp for 1 point. And if they're scalping for 1 point, they don't have a lot of confidence that we're going straight up. Trading range day legs typically last a couple hours or so, sometimes 3 or 4 hours, but usually at least a couple hours. And that is another reason to think that a reversal here probably will not go very far. And we started this at bar 7, and this is bar 23, and that's not 2 hours yet. Bulls, because of the expanding triangle, you can also call it a wedge, and a micro double top, I would get out of lungs below even a small bear bar. And bears, aggressive bears, will sell. Other bears will wait for a higher probability sell. The bears selling below 23 are hoping for this, but they know the odds are against it. That's the bear bar. Odds are buyers below minor reversal. I'm not sure the stop order bears will make money. I don't think the probability is high enough for a scalp. And if you're expecting a swing, I think the probability is higher if you wait for 2, 3, or 4 bear bars and then start to sell for a swing. Bulls buying the close 23, trying to prevent bulls from exiting. They don't want it to go below 23 because they know a lot of bulls will exit and wait for a leg or two down. So a lot of the bulls are buying the close of 23, trying to keep this going up as long as they can. Right now it's an 8-bar, 9-bar bull micro channel and a 12-bar very tight bull channel. With a 9-bar micro channel since the 15 low, if we get a reversal down, it probably will be minor. If you have 5 or 6 bars on a micro channel, usually the first reversal down does not get very far. This is 9 bars, so despite the micro double top, 9 bars without a pullback, I think makes it a low probability short. For the bulls, it's a pullback and a bull trend, so theoretically it's a buy above 23 as well, but I think it's tough to buy above a bear bar when the rally is not all that strong. For the bears, they're hoping 19 is a breakout and that we get a wedge, 1 pullback, 2 pullback, 3. That's the end of the hour, and you can see the hour closed on its high. Bull flag, and we're breaking above the bull flag. Odds are, as I said, we'll probably go higher, but if we do get above this high today or tomorrow, I think there probably will be sellers not far above a potential final flag, wedge 1, 2, and 3. Bull bar closing on its high, but bad follow through on 20, 23, and third push up. So not a lot of bulls buying above 24. Bulls might start to look to buy pullbacks instead of breakouts. Limit order bears are sold the 20 high. Do you see what happened to them? It had to fall 5 ticks. 23, a good looking bear bar, but it's low, only 4 ticks below the 20 high. So right now the bears are trapped. I think the odds are we're going to pull back to the moving average starting soon. This is the third push up, so that is good. A lot of times on the 60-minute chart, you'll get a big bar closing on its high, and the market will go 1 tick above and then reverse. And you cannot see it on the 60-minute chart, but we did go 1 tick above that big bull bar. Bar 25 went 1 tick above 24. And there were more sellers than buyers. Not much downside risk when a channel is this tight. And now we have a 10-bar bull micro channel since the 15 low, or 11-bar bull micro channel. This is bullish. We know the bears are sold the 20 high, and they're trapped. The bears are sold the 18 high. We're trapped. We have a gap here. And here, no gap, but it only fell 4 ticks, 23 low, 21 high, and 20 high. So a small pullback bull trend, definitely good for the bulls. So when a rally does not look all that strong, yet it starts to form 2 or more gaps or body gaps, and it increases the chances that the trend could last a long time. With all of this early selling today, I do not think this is going to last all day. More likely, this will be a trending trading range day where we have an early range and then a breakout and an upper range. So this is probably a bull leg in what will be a trading range for the next couple of hours. And the market is searching for the top of this bull leg. Less likely, small pullback bull trend. Right now, we're in a small pullback bull trend, but I don't think it's going to last all day. Small pullback bull trend, we got a reversal. Here's small pullback bull trend, but for an hour or two and then sideways. So It started to be a small pullback bull trend, did not last. Here, early selling, beginning of a small pullback bull trend, did not last. A lot of early selling, small pullback bull trend did not last. I think this is going to be like today. Too much early selling reduces the chances that the small pullback bull trend will last all day. Traders are still buying for any reason, buying at the market, buying bear closes. They want to buy below bars, but they're not getting a chance. Every bar has a low at or below the low of the prior bar. So it's still strongly bullish. A pair of bull bars. Is it more likely an exhaustion move or the start of another leg up? Usually 60% of the time you get at least a small second leg up. 40% of the time you get a bear bar and a reversal down. $25 bars in a micro channel without a pullback. They bought the first pullback. 21 bars. They bought the first pullback. We did not go much higher, but they did buy the first pullback. 17 bars. Good looking bear bar, but they bought the first pullback. Here, 14 bars, and they bought the first pullback, but did not get much above that low. It turned out disappointed. Bulls, they exited on the test of that high close. This is much more climactic than what we have today. Over 2 days, 17 bar bull micro channel. They bought the first pullback, but this bar tested that close and we sold off. So the bulls who bought that low, I can't tell. I don't see the price scale. I don't know if they made money, but whenever you see a buy climax and then disappointed bulls and then a doji or a tail testing that close, reversing down, it often leads to a swing down. The bulls are giving up. So can you buy with a limit order on 26 low? I would not. I still think this looks like a bull leg in a trading range. Now the wedge is 1, 2, 3. Now what about a stop entry bear selling below 26? Let's say it closes on its low. I wouldn't do it simply because of a 10 bar bull micro channel. The odds are there'll be buyers not far below 26. Even if this ends up as the high of the day, there'll probably be buyers below 26. Limit order bears, some sold the 20 high, others sold the 25 high. Those who sold the 25 high have made their scalp. They sold the 25 high, they sold more higher. It looks like the ones that sold the 20 high probably are going to make money as well. So even if we sell off, probably sideways, minor reversal, and the bears will, this is unlikely. I would get out of longs below any bear bar. I would get out of longs 4 or 5 ticks below any bar, including a bull bar 25. Probably buyers below 25, buyers below 26. Or at least a point below. Look at the chart. Lots of reversals here and here, expanding triangle. Is this still an expanding triangle? I would not call it an expanding triangle anymore. We've gone too far above it. I think it's going to be a trending trading range today where we have a trading range, a breakout, and then a trading range. So this is probably the start of a upper trading range. Now, how far down will the bulls buy? Some will buy the 26 low and 1 point lower. Others will buy 1 point lower. And for the bears, I would not take the short. If we get 3 consecutive bear bars like this, then maybe sell to close. But right now, probably buyers not too far below. Again, trading range today. Trading range, breakout, trading range. Bears made money eventually selling 20 high and 23 high. They'll probably start selling bear flags 27 high. They'll probably start selling bull flags 27 high. And they'll probably sell the 26 high as well. Probably soon start to enter a trading range. Bulls, if they're buying up here, where's their stop? They got a problem. Their stop is way down here, maybe a few ticks below 20. Still always in long. Bulls hoping small pullback bull trend lasts the rest of the day, but I think more likely it'll be a trending trading range today. Early trading range, breakout very strong, but basically an upper range. It was a bull channel. We rallied the rest of the day, but basically trading range trading. Here, just sideways the whole time. Trading range, pretty good breakout, and then trading range. Small pullback bull trend like today, but then pretty much sideways for the rest of the day. It could remain a small pullback bull trend, but we have a lot of early selling. We've been sideways for 3 days. Yesterday was a doji day. All of those factors, I think, make it more likely that this is going to start to go sideways here or soon. A lot of the bulls will want to buy a pullback closer to the average price. We got a spike pullback channel, another spike pullback, possibly 1, 2, and then 3. We have that measured move target. So somewhere around where we are or a little bit higher, we'll probably start to pull back. Getting close to the measured move target. As I said, I have it drawn from 12, but some computers might be drawing it from 8, which takes us closer to yesterday's high. And then other computers will be drawing it using the entire range. Getting drawn up to the targets. Limit order bears made money in here. They're probably selling about 26. Stop order bears might sell if they get a strong sell signal bar 29, but even if they do, they'll probably be only scalping when the channel is this tight. This would be a credible stop entry short if it closes on its low, but it probably will turn out to be a scalp, a pullback to the moving average. Bulls, I would get out below a bear bar. I'd get out below 29. You can see some profit takers. We got to within a tick of the measured move, and some bulls, when there's an obvious measured move target like that, based upon the height of this leg and this gap, some bulls will place a limit order 1 tick below, just in case it does not quite reach the target. We still have other targets above, and as I said, this is a minor reversal at best. Bulls hoping for another high one buy. If we get 3 bear bars, the odds are we'll probably get a couple legs sideways to down. For the bulls, it's a high one by 30, but we're at one measured move target, and the bears have a credible sell. A lot of the bulls will wait for a couple legs sideways to down before buying. They'll wait for a second buy signal. If they buy here, stop at least a few ticks below 20. Bulls, I would get out. I'd be flat, and I would not buy above 30. I would wait for a second buy signal. Suppose we get 2 or 3 consecutive bull bars, then it could become buy the close again. But right now, I would wait for a couple legs sideways to down. I did not buy above 30, even though we're still always in long. We had 2 reversals here, 1 and 2. Even if sometimes you'll get 3 or 4 consecutive decent sell signal bars, and the market will keep going up. When that happens, it usually comes back to those sell signal bars later in the day. For the bulls, I would wait. I'm not willing to take the buy. I'll wait for a high 2 or 2 or 3 consecutive bull bars before buying again. I still think this is going to evolve into a trading range. I don't know if I have an example of something I want to show. Sometimes you can get a bull channel, and you keep getting sell signal bars, but the market just keeps going higher. So we're channeling up bear bar, bear bar, bear bar, bear bar, and it just keeps going higher. So when the market's in a fairly tight bull channel, selling below a bear bar is not as high a probability bet as you think it would be. When the market's in a bull channel, it's always forming a wedge top of some type, yet a bull channel can go up a long, long way. Bears trying to get a second sell signal, 31. As I said, I would not buy above 30. And if the bears do get a second sell signal, I still think a minor reversal is more likely than a bear trend. I think the best the bears can hope to get is maybe a test back down to the moving average, maybe all the way down to the 5 high, the gap. But right now, over the next few bars, I think the best they'll get is sideways, like this. That's in a bear trend, but be the same thing. I think the best they'll get is sideways. Usually you have to stop the rally by going sideways before the bears can get a swing down. Tight bull channels usually do not become bear trends without first transitioning into a trading range. Not a very good sell, so the bears are still not getting very good sells. Limit order bears made money selling above 29, but stop order bears have not made money since bar 10. With the bear bars here and here and here, a lot of the bulls are not willing to buy at the top of the channel. They want more of a pullback. Another high one, and we still have room to yesterday's high and that measured move target, but it's forcing bulls to buy exactly at the top. So I'm trapped out. I'm waiting to buy closer to the average price. If the bears get an II here, consecutive inside bars, that would be a credible sell signal, but it still would probably be a minor reversal. I have that measured move target in, and then I have this one drawn. There's also the one from this low to the gap. So there are several magnets here, a little bit higher. This, yesterday's high, and up there. We don't have to get them on this leg up. We could pull back and then get them. My problem with buying here is it's only a 2-tick pullback here and a 1-tick pullback here. I want to buy lower. Remember, you have bears, you have bulls who exited below 29 and they want to buy again, but they don't want to be buying only 1 or 2 ticks from the high of the day. So a lot of the bulls do not want to buy up here. So you have some bulls they want to buy but not here, so they're waiting to buy a pullback. And if there are not enough buyers up here, then we'll have to go lower to find buyers. Since it's not a very good sell 33, you'll get some bulls buying 33 low. That allows them to buy a little bit lower. Other bulls, I did not take the buy. I'd like to get a couple legs sideways to down and closer to the moving average. Friday was a doji bar. That increases the chances that today will be a doji bar as well. But we're fairly far above the open of the day, and right now the odds are against a sell-off getting all the way back to the open. So today will probably not be a doji day. However, it still could be an inside day. A doji day is a neutral day, and Friday was a doji day. So you got to be thinking there might be some sellers just below Friday's high, and we may turn down from just below Friday's high and enter a trading range. Bulls, everything is a high one, above 30, above 32, above 34, but a lot of bulls like me don't want to buy at the high because we're getting too many bear bars. Market's deciding, are we going to get above yesterday's high, or are we going to pull back first? I think we're probably going to pull back first. It looks like we're starting to bend sideways, so we're losing some momentum. Stop order bears. It's a small pullback bull trend, and that's a tough way to make money selling with stops when the pullbacks are small, because you need it to fall 6 ticks from your entry, from the signal bar low, to make money. And if the pullbacks are small, you're betting on a bigger pullback than what we've had in 20 bars. I think a lot of bulls get out below 29. I would get out below 35, if not below 29. What about buying at the market and getting out below 35? That's interesting math. Low risk, but the reward is probably not all that great either. So I'd rather buy closer to the average price. How big a reversal can we get? Unlikely to go straight down very fast, but if we get 3 consecutive bear bars, we'll probably get a couple legs down and start testing prior lows like the 25 low, maybe the 21 low. There's still a lot of time left in the day, so we could easily pull back to the moving average and still get up to yesterday's high, Friday's high. Not a lot of bulls, they've stopped buying, right? The bulls have bought about 30, 5-tick trap, right? The bulls have bought about 32, above 33, 34, have not made money. So those bulls are going to start thinking about trying to get out with a smaller loss, or trying to get out around break even, and then look to buy again lower. Limit order bears made money selling about 29, selling about 34. So limit order bears are making money. Stop order bulls are not making money. So that increases the chances of a transition into a trading range. Is anybody going to buy above 36? Not a lot of traders. It's the top of a tight trading range. It's the same problem buying above 36, the same problem with buying above 30, 32, 33. You're buying too close to the top of a rally, and the rally is getting weaker. So bulls are not buying, and bears so far are not selling, except with limit orders at the highs. And so we may end up going sideways here. If bears only want to sell above things and bulls only want to buy below things, it can transition into a trading range. Stop order bears needed to fall 6 ticks. Is this enough of a pullback for the bulls to buy 37? I would wait for a couple legs sideways to down. What's happening right here is the fight over the appearance of 37. Traders know if it's a third consecutive bear bar, the probability of a couple legs sideways to down goes up. So if the bulls can prevent it from being a third consecutive bull bar, a third consecutive bear bar, the bulls might be able to make it go sideways and then up instead of a couple legs down. So I'm buying both 37. It's a high one. We're always in a long, small pullback bull trend. It's still a buy. In a small pullback bull trend, there are two things that go on. First of all, pullbacks tend to be small. Here we dropped 2 ticks. We dropped a couple ticks here. We dropped 4 ticks here. And also, the pullbacks tend to not have a lot of bars. So here we fell 2 bars, and so far 2 bars here. So it's still a swing buy. I don't think the probability is high enough for scalpers, unless they're using a very wide stop. I'm going to wait for a couple legs sideways to down. If this was taking place above a trading range, I would be more willing to buy above 37. But we're right at the top of a 2-day trading range, 3-day trading range, and that makes me less willing to buy the small pullback bull trend. So I'll wait for a couple legs sideways to down and see what we get near the moving average. The close of this bar is important. Even a 1-tick bear body would increase the chances that we've begun a couple legs down to the moving average, the 30 low, and maybe even the 27 low or the 20 low. Doji bar, so fairly neutral, but most bulls, I think, prefer to buy closer to the average price when the price action is no longer much greater than average. You can see sideways from about 7 bars tight trading range. That's not strongly bullish. So traders would rather buy closer to an average price instead of paying above average for a rally that is no longer that much above average. We're making money selling at the high. What we don't know is whether limit order, stop order bears will make money selling below 35. That would increase the chances of more sideways to down. Bulls, high one, small pullback bull trend, further below the high of the day. So you might get more bulls willing to buy here than there were above these bars where they had to buy 1 or 2 ticks for the high of the day. 37, not a bear body. So the bulls were able to stop it from becoming a third bear body. So the math is not horrible for the bulls, but I still think it's more likely that we're going to go sideways to down and get closer to the moving average. And I also think that even if the bulls make money buying above 38, they're probably not going to make a lot of money. It's trying to enter a tight trading range, and therefore sellers will sell above bars. They might sell above 38 if it's not a bull bar closing on its high. We know they'll sell at the high of the day because they've been making money since selling above, since selling above 20, they've been making money. Selling above, selling a point higher, 2 points higher, and then when it comes back to their first entry, break even. They sold that high, they sold more higher. So limit order bears have been making money all the way up since bar 20. Stop order bears have not yet made money. Stop order bulls have not made money in an hour since bar 27. So becoming less bullish, more neutral. The bulls will buy above 38. Do they put a stop below 38? I would not. I would use a wider stop because there may be sellers above 37 and we may get 2 or 3 small legs sideways to down to the moving average. So I think these bulls probably put a stop down here. They don't intend to let that stop get hit. They'll get out before it gets hit. A lot of bulls will wait for a second buy signal and not buy above 38. I'm not planning to buy above 38. What happens if we go above 38 and we do this? Well, I'll probably buy the market as it's doing that. Not a very good buy signal bar. Therefore, a lot of the bulls will wait until it gets closer to the average price. Bulls trying to get a high 2, that would be a higher probability buy, but it's still above the moving average, and we're still in a tight trading range. So I still think it's not a very good buy. And for the bears, they're still on their short below 35. Most bears will get out above a high 2, for example, 40, if it triggers and if it has a bull body. Some will hold. If this high 2 reaches the moving average and forms, I think most bears will get out. 6 ticks down, so stop order bears made money. Limit order bears have been making money for 20 bars, and now stop order bears are making money. So that is more evidence of the bull trend transitioning into a trading range. Is it still a small pullback bull trend? Sure, the pullbacks, even though we've been selling up for 6 bars, it's still a small pullback, only 6 ticks. Bulls trying to get a high 2 buy signal, 41, but things are more confused because stop order bears are making money. Limit order bears have been making money all day. Odds are we're going higher. Odds are this is not the high of the day. However, I also think we're not going much higher. I think the market's going to have a hard time going above Friday's high, and therefore we may go above 35 and then stall. It'd be a bigger wedge. 1, 2, and then 3. I don't think we'll reach that line. Limit order bulls bought 39 low, 38 low. Stop order bulls, I said they want a high 2. They have a high 2 here, and it's just above the moving average. But the tight trading range, I think, makes it not good enough for a scalp buy. Then you're left with a swing buy. However, I think if we get above 35, we're probably not going much above, and therefore it's not a very good swing buy either. So I'm going to continue to wait to buy. The bears who sold below 35, hoping, most of them expected a scalp. They thought tight channel, it's probably not going to be a bear trend. But we might pull back to the moving average, which is what we did. And the stop order bears made a point. Could they hold short for a swing? I would not, because a small pullback bull trend, unlikely to become a bear trend without entering a trading range first, which means selling below 35, you're expecting a trading range, not a trend. And therefore, I think most of the bears, when they did not get a third bear bar 37, they decided, I'll just scalp out. If they had a third bear bar, if we started to do this, they would be willing to hold, taking a chance on a swing. But 37, then 38, 39, I think a lot of the bears decided just to take the 1 point. That's part of the reason why it reversed up exactly 6 ticks below 35. Stop order bulls, for me, not a good enough buy. Tight trading range, and probably not going much higher than 35. Nobody wants to buy up there. At least I don't want to buy up there. So I think bulls better off waiting. Bears probably will sell above 35, and they might sell 40 high and 1 point higher. Nobody buying, right? More traders selling than buying up there. For the bears, it's a lower high, but probably only a minor reversal. We only had a couple bars up, usually that's not enough to create a major trend reversal. Sideways now for about an hour, 60-minute chart. We may go a little bit higher, we may get a wedge, 1, 2, 3, but we're probably not going a lot higher. And we should come back down here, the apex of this triangle. Difficult if you're a stop order trader. I think it's pretty difficult here. Since bar 29, this is 13 bars later. Only once have stop order traders made money below 35. All the trading has been limit order trading. Bears lost below 29. They lost below 31. They lost below 39. The Bulls lost below 30, 32, 33, 34, and 38. And so far, they've lost above 41. Limit order bears selling 39 have not yet made money. So a very tight range. Best choice, I think, wait. It's hard for both stop and limit order traders to make money here, bulls and bears. Still always in long, but not, you can argue 20 gap bar buy, the gap below this bar and the moving average. We've had more than 20 bars with gaps, and you had limit order bulls trying to buy at the moving average or one tick higher, and they did not get filled. If you placed a limit order to buy one tick above the moving average, you did not get filled on bar 40. So very difficult to do anything right now. The bulls see 42 as a pullback from the 41 breakout of a high 2 bull flag. The bears see 42 as a double top, lower high double top, 35. Both are correct, but I think it's better. It's still always in long, so it's more likely to go up than down. However, I don't think it's worth trading this. I think it's better to be flat and just waiting for a better pullback to buy or a better top to sell. Bulls trying to break above yesterday's high. But yesterday, Friday, is a doji bar, so not a strong buy signal bar. Probably sellers not far above. Wednesday, Thursday last week, a pair of surprisingly good bull bars. Odds favor at least a little bit more up. Today and tomorrow could be that little more up, but I think we'll probably get a reversal this week and start to come down to this tight trading range, daily chart. Less likely we break above the triple top without pulling back. More likely we're going to pull back before trying to get above the triple top. Small wedge inside of a bigger wedge. Three pushes up, 39 pullback, 41 pullback, 43. Does not matter that 40 fell below 38. It's still a wedge. But the bears need a sell signal bar, 44. That would be a more credible higher high major trend reversal. But it still does not have very many bars, and therefore it probably will not be a major reversal. It probably will be a minor reversal. Minor reversal means trading range. Remember I said I thought today was going to be a trending trading range day, where we have a trading range, a breakout, and then another range. I think that's what it is. It's still right now a small pullback bull trend, but I also think that we're in an upper range. If the bears get a good sell signal bar, 44, they'll sell, looking for another test of the 40 low and the moving average. or another test of the moving average, and around 40 low. Consecutive inside bars, possibly. If 45 stays an inside bar, especially if it closes on its low, that would be a credible sell. Nested wedge. So bigger wedge and then a smaller wedge inside, but the bears need a good sell signal bar. It's a credible short if it has a bear body. Obviously, the odds are against it being a major reversal. We're in a quiet trading range, but that would be a credible short for a couple legs sideways to down. For the bulls, it's an II bull flag with targets above. I would rather have it go above and reverse down than go below first, because we have magnets above, so it could easily go below 45 and by a tick, and then go above 45. This is one of those examples where you have a small sell signal bar, 45, and a credible sell setup. Whenever you have a small sell signal bar, the probability is you're going to get stopped out. So if you sell below 45 and put a stop one tick above 45, you're probably going to lose money. If you sell below 45 and put a stop 2 or 3 points above 45, you have a much better chance of making money. A lot of times when you have a small sell signal bar like these, most of the time, if the sell triggers by going below 45, the market will go above 45. However, if it does do that, if it goes below 45 and then above 45, it usually only goes 2 or 3 ticks above 45 and then reverses down a second time. And then you get some kind of a couple leg move down. For the bulls, an II and a bull trend, so an II bull flag, targets above, but probably not going much higher. Still a small pullback bull trend, but because of this early trading range, a lot of bars, 20 bars, more likely this is a bull leg in a trading range. It's still a bull trend, it's still a bull leg, but it's in search of a top. So I would rather have it go above 45 and then a bar or two later go below 45. I think that would be a higher probability sell. You'd have trap bulls who bought above 45. And as I said, if it goes below 45 first, better than 50-50 chance it'll quickly go back above 45. And if it does that, I would say at least a 50-50 chance it'll then reverse back down a second time. So tough call, right? I did not buy it. It's a II bull flag, always in long. Yesterday's high, magnet above, measured move target from here above. But my concern is tight trading range since 29 and nested wedge. I think we're probably going to come down to the 40 low and maybe lower. So I did not take that buy. It's still a nested wedge, but not a good sell signal bar. Can you sell below the II, below 44? Remember I said I thought if we went above the II, we would reverse down and go below it. That's still true, but it's really not very good stop order trading. So even though I think we're not going a lot higher, I'd like to see better sell signal bars than 47 and 44. So best choice still probably flat. Stop order bulls, they made money above 41, but that was their only profitable scalp in 20 bars. And stop order bears again made money selling below 47, a bull bar, so most traders did not take the sell. However, the bull trend, which was strong for a couple of hours, is transitioning into a trading range. I have the wedge drawn this way, but it may end up being nested this way, 1, 2, 3, and then smaller wedge, 1, 2, 3. As you can see, I keep talking about wedges. It's because I think this rally is going to top out, and it'll clearly become a trading range before the end of the day. For the bulls, another small pullback, 2-bar pullback, still above the moving average, and still a target above, but most bulls are not going to buy above 49. And for the bears, I would not sell below 47, 2 bull bars. I would not sell below 48, right above the moving average. They are selling at new highs. They've been doing that since bar 20, and they've been making money every time. At some point, they'll start selling bull flags. 49 is a bull flag, high one bull flag. So at some point, bears will start selling. Instead of waiting for a new high, they'll start thinking that maybe we'll get a lower high, and therefore I will not get filled if I try to sell 47 high, so I'll sell 49 high, betting on a pullback to the 40 low. Are we at that point yet? I think some bears will sell the 49 high and sell more higher. Trading range type trading, not a good sell signal bar 47, not a good buy signal bar 49, and tight trading range since 29. Probably more limit order traders sell 49 high, sell 1 point higher, sell 46 high. And the bulls are trying to buy below things. They bought the 47 low, and they were able to buy 1 point lower. And the reason why we're not going very far up or down is traders are scalping. They do not believe we're going to go very far. So they're buying low, taking quick profits. They're selling high, taking quick profits. I think it's pretty interesting that we did not pull back and we did not touch the moving average. I'm trapped out. I did not buy above 50, but it is interesting that the two sell-offs, 40, 49, neither one got to the moving average. That means the bulls were pretty aggressive buying above the moving average. We're up to that measured move based upon the initial sell-off. We're also up to Friday's high. What trace vision is really annoying. Surprise bar up, and I'm missing it. I'll have to see. I'm gonna normally I like to buy surprise bars as they're forming. I did not buy this one. My concern is too much limit order trading here. Friday's high is also last week's high. So we just went, this is the weekly chart, we just went above last week's high. Remember, this week I think it's going to be a bear bar after 6 consecutive bull bars in the middle of a trading range. What about the bears that sold the 46 high? What's going to happen to them? I think they probably will make money. But I also think that whenever you get a surprise bar, you got to be thinking we might get a second leg up. Can this be an exhaustion bar? It could be. It would be more likely if it was bigger. Sometimes you don't get a big one, you get 2 medium ones, which we might get. Right now, we're probably going at least a little higher. Well, theoretically, buy the close, but I'm going to let it go. We've had too much two-sided trading since bar 20. Big enough breakout. If we get a bear bar 53, more likely a pullback and at least a little bit more up. This is the debate right now. If you get the biggest bar late in a bull trend, it usually fails and we get a reversal, exhaustion, gap bar. Here we have a bull trend as well. We have a very big bar. The difference between this and that, here we have a channel, here we have a trading range, so a sideways channel. And this has more chance of leading to a swing up. Today, what does today resemble more? This or this? Here's today. It resembles this more. Strong bull bar, expect at least a small second leg up. So bull bar, pause, second leg up. And if we get a reversal at that point with a credible bear bar, it would be an okay sell for a swing down. What do the bulls do? Do they get out below 53? Well, if it has a bear body, I think it's okay. I don't think we're going to get much more up. And for the bears, I think they need a bear body closing on its low and probably at least a 3-tick bear body. Otherwise, most bears will wait. So it's still by the close, probably a small second leg up, but probably not much more up. Bulls, I'd get up below bear bar, and I think you can get up 4 or 5 or 6 ticks below any bull bar, just in case we get a big surprise bar down. You don't want to be getting up, 4 points below 53. So to this, traders are hesitant to buy too high. Still a small pull back. Bull trend. Excuse me about my voice. Bull's trying to get it to last all day. Trying to reverse, yet it keeps working higher. And a lot of the stop entry buys are tough because the rally does not look strong. It's forming these tight trading ranges. So you're constantly buying at the high. And same today, buying above 41, buying above 50, buying above 30, you had to hold for 20 bars to make money. This is too far up, I think, to buy. Better to be buying closer to the moving average. Market's ignoring these wedges, so I'm going to remove them. You can see the market just removes any trend line. I click remove this line, and it removes other lines. Breakout surprise bar. Usually you get a high tick reading, and you can see that was the highest tick reading of the day. Usually not the final high in price. Even then, it's not all that extreme. It's only 700 ticks, not 1,000. Bears hoping for exhaustion, 52, and a reversal down. Bulls, I think, get out below a bear bar, and bears, chances are, if 55 is a bear bar, chances are 55 is a bear bar. It's not going to be a very big bear bar. And therefore, a lot of bears will wait to see if we get 3 bear bars before settling. I took limit order trades in here, and I have not done anything here. There are no other nearby targets. Here's the daily chart. We have that measured move. From this low here, I don't think that's important. I'll get rid of that. And then the next target is that triple top. As I said, I don't think we'll get there without pulling back here first. No sign of a top. The reason why traders buy here is because they think if we reverse down, we're not going to fall that far. And it will probably come back up here before the end of the day. So they buy, hoping it goes up enough for them to make a profit. But if it does not, they're confident the reversal down will not go very far. And it'll be a bear leg in what will become a trading range. That means there'll be a bull leg, and they can buy more lower and get out at their first buy, break even on their first buy, and a profit on their second buy. I am flat. I don't want to be buying this far above the average price, and there's nothing to sell. You have 7 consecutive bull bars, and the pullbacks right now are very small. Possible exhaustive buy climax. Sometimes you get a strong rally late in a bull trend, and you think the market's going to go a lot higher, and it just reverses. And this is this could be an exhaustive end of this trend, even though it looks like a small pullback bull trend. That's why I'm not buying up here, and there's nothing to sell. This is an example. Small pullback bull trend, and you have a whole bunch of bull bars at the end, and the rally just stops. And this becomes exhaustion, and the market turns down from there. Here, did not turn down all that much to the bottom of the buy climax. And today, if we turn down, that would be the target, the bottom of the buy climax, which is down here. I think difficult to do anything here. Bears, I think, need a second sell signal. And bulls, well, they might buy up here. The market came close to the moving average twice. I think most bulls would rather buy lower down. So not enough buyers, and maybe not enough sellers either. You can see here the market had to go sideways for about 10 bars. And then at the end of the day, it just sold off for a few bars. So it's going to be difficult. It probably is going to be something similar to this. You sell below that, and then you get a buy signal over here. Do you hold short? Your goal is to get to the bottom of the buy climax, and that would be down here. So if you take that kind of a trade, that's what you do. You hold short. Another wedge. As you can tell, I have not been very bullish or bearish since around bar 30 or so. A little bit bullish, 52, but as I said, it was possibly an exhaustive end of the rally. We can continue up but I don't want to be buying that far up. So right now I'm trapped out. Sorry about my voice. Here, bears got down to the moving average, first time all day. That's a buy, 100% buy, 100% of the time. If the market has not touched the moving average all day, 99.9% chance it's going to reach the moving average, and you'll get at least a bounce. The first time the bears do anything, the bulls buy it. The first time there's a bear bar, they buy it. The first time it touches the moving average, they buy it. The first time there's a close below the moving average, they buy it. Bulls hoping it's just another small pullback, and then we keep going up, similar to this. A lot of bull bars. The bears tried to get an exhaustive reversal, instead bull flag. So that's what the market's deciding. Is the current rally like this, bull flag, or is it like the other one that I showed, possible exhaustion? I think exhaustion is more likely, but we're probably not going to get any good trading for the remainder of the day. I think since around bar 27 or so, there have not been a lot of good trades, or a lot of good stop entry trades. What happens to the bears what happens to the bulls who get out below 58? I would not buy this high. So even though it's a high one and the bull trend got stronger here, I would wait for a high 2 buy and closer to the moving average. And for the bears, I would wait for at least a second sell signal. So the bulls and bears might be waiting, and the result could be a tight trading range for a few bars like this. Then the market decides, is it a bull flag and do we go higher, or is it an exhaustion and we go down to the beginning of the Y climax? What about betting that this is a possible exhaustion move and therefore selling above 59? With a bull bar, I would not sell above 59. You might sell above 58, a bear bar, but I think it's difficult to make money buying or selling. For the bulls, I would wait for a high 2. By the time you get a high 2, you'll be thinking that we're going to come all the way down here. We'll see. It's still possible that the bears could get a decent looking double top with a decent sell signal bar. It's also possible that the bulls could get a small high 2 bull flag at the moving average with a decent buy signal bar. Those would be the 2 stop entry trades that I would look for. Limit order bulls bought 57 low and 1 point lower. It fell 5 ticks, so they could buy 4 ticks lower. They needed to get 1 tick above that 57 low. I talked about this earlier in the day about the limit order traders. So if 61 gets to the 57 low but not above, a lot of the bulls will get out on a reversal down. So we'll get some information. Are the limit order bulls trapped? No evidence of that yet. Still small pullback bull trend. Can you see what happened there? This is exactly what I said might happen. It gets to the 57 low, but not 1 tick above. And the limit order bulls who bought 4 ticks below 57 were not able to make 1 point. And part of the reason why 61 is turning down is those bulls are trying to get out, break even. It hit their limit order at the 57 low, had to get above that price to scalp off for 1 point. And when it hit their price and turned down, a lot of the bulls are deciding to get out, break even, or with a 1 or 2 tick profit. For the bears, a micro double top, but 3 dojis right above the moving average. So not a very good sell. What do? Best choice, flat. Second best choice, you could buy. I would not buy the high 1. I would wait for a high 2. And third best choice, well, you could sell the 60 high too late now, I did not do it. And for a stop entry bear below 61, I would not do that. There probably are buyers around the moving average, like 40 and 49. Still always in long. A lot of bulls, most bulls probably did not get out below 58. They're still long. They might get out below 59 now that we have a micro double top. So a big wedge and a micro double top and a buy climax, but buyers probably not too far below. The bear's selling. I'm not opposed to being short below 58 or 61, but if you're selling, I think it's better to be holding for a test of the 50 low, the buy climax low, instead of a 1-point scalp. The math, I think, even though you'll lose most of the time, you'll probably win often enough for it to be a profitable strategy. Scalping, selling below 59 or 61, I think the probability is not high enough. You know, you're risking 7 ticks to make 4 ticks. You know, you have to be right 80% of the time just to break even. I do not think it's an 80% probability that you make 1 point before losing 7 ticks. Like double top sell, but right above the moving average. So swing only, more likely will go sideways. We have not touched the moving average in 35 bars since down here. We got close a couple times, but never touched it. So we probably will touch it here. 35 bars is an unusual number of bars without a touch of the moving average. And I think we're going to touch it within the next 2 bars. So even though we have a high 263, I don't think it's worth taking the buy. Let me update this real time. Sometimes with the market, if a bar closes on its high, it can suddenly pull the moving average up to the low of the bar. So if 63 becomes a big enough bar, all of a sudden, when the bar closes, it'll look like the bar touched the moving average. And as far as computer testing goes, that is good enough. I think we're going to go more sideways to down. Minimum touch the moving average. High 2, but I'm not taking it. Too many bars above the moving average. So probably we'll come back to the moving average in the next few bars. The bulls were very eager, 41.50, buying above the moving average. And you have some bulls doing the same thing right here. Instead of buying 1 tick above, they're buying 2 ticks above here and here. That's pretty eager bulls. I think we came very close to it twice. We probably have to come all the way to it this time. So I would not, okay, there we go. So I would not be buying with a limit order here. Bear is trying to get down to the 50 low, the bottom of the most recent buy climax. Still always in long. And there will be some buyers here, but I think it's slightly more likely this is an exhaustive move than a measuring gap. You can see we're testing the 46 high, the breakout point. Because we finally hit the moving average, bulls will be more willing to buy. And you can see not a lot of buying over the past 5 bars. You know, the market's not going up. And 64, a surprisingly big bar. It's not all that big, but it happened pretty quickly. And it probably represents a lot of the bulls giving up. The bulls who were buying here gave up. The bears who sold probably scalped. We fell 6 ticks below 61 and bounced. That tells you that a lot of the bears who sold below 61 were looking for a 1-point scalp. Now for the bulls, it's a high 2 or a wedge. It's a high 2, 59. It's a wedge, 3 pushes down, 58, pause, 50, 61, 62, pause, and then 64. So 3 legs down, but tight bear channel. Bear bar, so not a good buy above 64. We may have seen the high of the day. I think this is what we might be doing. Selling off just a little bit and just working lower. So I think buy climax pullback is more likely than bull flag, where you sell off, but you then keep going up. Buy climax, bull flag. There are limit order bulls who bought the moving average with a limit order at the moving average, thinking we would get at least a tick below, and they're trying to scalp out. They need one more tick. In this kind of a situation like we have here, I placed a limit order to sell 5 ticks above the moving average. After I saw bar 62, I placed a limit order to sell for a 1-point scalp. I thought I was pretty confident, very confident, that we were going to touch the moving average and get at least 1 tick below it. 65, the first reasonable stop entry buy since maybe the 52 high. But tight bear channel and possible double top 61. So I'm not going to take the buy. I'll wait. This looks like a tight trading range, which is more of a limit order market. So bulls buying below things, 60 low, 1 point lower, buying at the moving average, selling above things, and scalping for 1 point. Certainly an okay swing buy. I don't know about a scalp, even though it's a 20 gap bar buy, it's 30 gap bar buy, almost 40 gap bar buy, but tight trading range and buy climax. So I'm letting it go. For the bears, double top 61, but limit order market, tight trading range. I would not sell 65 high. It's a high 2, a 20 gap bar buy, a bull bar closing on its high at the moving average. So I would not sell it, but I'm also not buying it because of the tight trading range and this buy climax. By the way, Google Alphabet reports its earnings after the close today. Top of a trading range, but a swing up, who knows, right? I usually do not take trades based on earnings going to earnings. I take trades, sometimes I'll take a trade going to earnings, not because it's going to earnings, but because the chart looks like it's a good setup for a profitable trade. But going to earnings here, we're at the top of a trading range, good for the bears. Tight bull channel, good for the bulls. I think when you go into earnings, in general, 50-50 chance you're going to get a quick move up, 50-50 chance you'll get a quick move down. The market usually tries to be neutral into earnings. Double top, lower high, double top 61. Sometimes you'll get a tight trading range like this, and you get a double top in the tight trading range. The market then has a big reversal down, major trend reversal, double top, lower high, major trend reversal. When that happens, the tight trading range usually has more bars than this. So I think this is probably not going to lead to a swing down. Here, strong trend, tight trading range, lasting about 20 bars, and there's a small double top. This double top is slightly below that high, and the bears got a breakout and some follow-through bars and a bigger breakout here. Another example, tight trading range with a double top and bear bars, 3 or 4 bear bars, swing down. Tight trading range, double top, bear bar follow through, did not go a lot lower, at least not initially. It went lower the rest of the day though. Tight trading range with a small double top. They never look like they're going to lead to a trend, but if you get a pair of bear bars closing on their lows, you're probably going lower. So that is important, this bar and the next bar. Remember I said I think we're going to get down to the 50 low, the buy climax low. We might go lower, but that's always the first target. Whenever you have a buy climax and then a reversal, first target is the bottom of the buy climax. The bulls are hoping 67 is just a pullback from 66, breaking above the double top, the high 2 bull flag. And the bears hope that we break below the neckline, 64, of this double top and fall for a measured move down, which gets us near the target. Tight trading range. Math is not good for anybody. Hard to sell with a limit order, 65 high. It's a high 2 above the moving average. Close on the high, 20 gap bar buy, so hard to sell that high, and hard to sell below 66. In these double top bear flags, I want a sell signal bar that is a bear bar. Like here, double top but a bear bar. Double top but bear bars here, right? Tight trading range, double top but a bear bar. Tight trading range, double top, bear bar here, another one here. Tight trading range, double top, bull bar, lower probability sell. Bears trying to break below 64 and get down to the 50 low. That's their minimum target, the bottom of the buy climax, the bottom of the most recent buy climax. But right now, I think best choice flat. Bulls trying to get another buy. They're hoping that they have a high 265 with 60, 65, and they're hoping 68 is a pullback from the breakout 66. And the bears hope that we have a double top 61, 66. Very difficult to do anything. Bulls buying above 65, bears selling below 66. Neither one is making any money. Limit order market, traders doing the opposite are making money. This would be a higher probability buy 68 if the bulls get a decent bull bar. So if you get a 2 or 3 tick bull body closing on its high, the bulls would buy, hoping for trend resumption up, a new high of the day. What about buying on a stop above 66, double top 61, 66? Don't the bears give up at some point? Yeah, the bears, if the bears were still short, they'll probably get out above 61, a bear bar. Not high enough probability for a scalp buy above 68. If you buy above 68, you're taking a swing, hoping that we get a trend up, so spike, pullback, channel. Most traders should not trade in this kind of environment. Very tight range, limit order market. Easier to make money with limit orders, which means difficult to make money with stops, which is the other side of a limit order. If you buy with a stop, somebody else is selling with a limit. If you sell with a stop, somebody else is buying with a limit. So you should think of them as opposite. If the market's in a trading range, limit order traders make more money. If the market's in a trend, stop order traders make more money. They're betting on the trend continuing. Limit order traders are betting on reversals. You can see the problem, very tight range, so the probability is not good. You're risking 9 ticks or 11 ticks. What is your goal? Are you trying to make 1 point? No, you cannot do that. You cannot risk 11 ticks to make 4 ticks. So if you're buying for a swing up, and the probability is not all that good, and the reward is probably not all that good. If we do have a swing up, how high up do you think it'll go? We do not have any obvious magnet up there, so if we rally, it's probably not even going to be as strong as this. So best choice, flat. For the bears, they're expecting a second leg down. So 1, ABC pullback, and then 2. We see this a lot where the first leg down does not look all that convincing. The bulls try to get a reversal up. They have decent buy signal bars, yet it does not go up. The bulls give up, and you get the second leg down. So selling below 69 is higher probability than selling below any of these other bars. And I think the bulls, first of all, I would not buy above 65 or 68. The bulls who did buy, I think, have to get out below 69 if it has a bear body, especially if it has a 2 or 3 or 4 tick bear body. So possible second leg down, 1, ABC pullback, and then 2. 1 tick bear body, not all that great for the bears, but it's still a problem for the bulls. I still think, right now, I think it's more likely we're going to go lower. If we're going to go anywhere, I think down here is more likely than up there. Do I think it's a lot more likely? No, the market's telling us that it's just about 50-50. However, I think this is probably an exhaustive buying climax and that we're going to try to test it slow. The bulls do not have any other targets nearby. If there was some obvious target just a little bit above, I'd say, we'll probably go up to the target, but we don't have that. I drew the measured move based upon the height of that expanding triangle. Some computers might use yesterday's low as the start of the range, and we've already reached that target as well. I could draw a channel across these highs, and that's too far up to get there today. So based upon this 5-minute chart, I don't see any other target within reach. So it's not like there's a very strong magnet above pulling the market up. The sell below 69 did not trigger. It's still on the buy above 68 or the buy above 65. I'm currently flat. I don't like trading when the range is very tight like this at the end of the day. Tight trading ranges earlier in the day, I often trade with limit orders. I do not like to trade with limit orders at the end of the day because when I do trade with limit orders, I like to scale in and I can run out of time and end up with a loss that's bigger than what I want. So the result is right now I'm trapped out waiting for either a breakout up or down, hoping for a buy the close or sell the close finish, or for a reversal with a good signal bar. And 69, not good enough. It's still on the buy, but I'm flat. Bulls hoping that we get trend resumption up. If everyone suddenly decides that we're going higher, we could get another bar like 52. A lot of times, well, I'm going to take that back. Do I think that'll happen? No. Look at what we have, right? It does not, there's no energy. A lot of the day was this way. Here we had 20 bars in a pretty tight range, and then now we're another 15 bars. They're still trying for the lower high major trend reversal. What I was trying to say a few minutes ago is there's an increased chance of 1 or 2 big bars up or down, but not an easy buy or sell to close type of trend. It'll probably just be 1 or 2 quick bars and then more small bars. So it'll be difficult to make money. Bear is hoping for a sell to close lower high major trend reversal. That bear bar 72, I think, reduces the chances of a buy the close finish, and therefore what's more likely is either a continued tight range or a sell to close finish. Probably a tight range is most likely. We have not had a close below the moving average and 60 bars since bar 12. Bears trying to get a sell to close finish here. Consecutive bear bars, but are they big enough for traders to believe it's the start of the swing down? I don't think so. So it's sell to close, but a low probability bet. This is the time of day when, if you're going to get a trend, the trend begins. But I think the bears have to do more. They obviously have to break below 64, and they probably need a bigger bear bar or two. And even if they get it, as I said, I think we'll have a hard time going below the 50 low. So by the time you decide, there probably will only be a point or two left to the trade. For the bulls, they're still hoping for a double bottom, but the consecutive decent bear bars, I think we're probably always in short, but I'm not willing to take that short. Not yet, at least. I don't like to sell at the bottom of a tight trading range. If we break below it, especially a big breakout, I might sell for a scalp. I also don't like to buy at the top of a tight trading range. So I would not buy above 68 despite a micro bottom and a good bull bar. Double bottom 64. We have a double top also 72, 58. But bar not closing on its high and still tight trading range. And we're running out of time. So I think very difficult to take any trades here. There's still a chance of a brief buy or sell to close trend, but it's unlikely. The bars are small and sideways for 15 bars. Bulls trying to get a buy the close finish, but sometimes these buy the close rallies, here we are starting, very late in the day. Sometimes they can go up a lot of points. So I'm not opposed to taking them, but I think they're very difficult to trade because half the time, I don't know about half the time, but maybe 40% of the time, they reverse very sharply and they erase a lot of any gains that a trader has. Here we had a very good bull bar and then a big bear bar closing on its low. So if you bought that close or above, you probably would have gotten out below and you would have taken the loss. If you held, you would have only made a point. So that's risk happens fast, and when a move is starting this late, I think there's a significant risk of a quick move against you. So I don't, when it starts this late, I very rarely would buy the market, buy the close. I usually just let it go. Too much risk of a very quick reversal, erasing a lot of good trades that you may have taken earlier. Becoming a good rally, the final 5 bars, if you bought the close or bought the close, you gave back. And if you took this trade 10 times, the 2 or 3 times that it does this will erase all the profits that you would have made by buying the close. Another example, very strong rally, very big pair of bull bars. If you bought that close, you may not have gotten out below that bear bar, you may have held, and then you get out down here, and you gave back a lot of profit. That might be the highest tick reading of the day. That increases the chances that we'll go at least a little higher by the end of the day. You can see the volume picking up on bar 78. This is the 1-minute chart. Bar 78 typically has the biggest volume of the day, and a lot of the volume comes in the final seconds. You can see the volume bar grew very dramatically in the final seconds. Best bull bar of the day, occurring very late in the day. Bears hope for a final flag reversal. Bulls hope it leads to a gap up and bull trend tomorrow. We'll find out tomorrow. I'm not willing to do anything today at this point. Daily chart, very tight bull channel going on for 6 weeks. This is the 7th week. No sign of a top yet. Yes, it's unsustainable, climactic, but there's no top yet, and a climax can last a lot longer than what traders think is likely. We had 10 consecutive bear bars here. That was pretty extreme. The market, I think, is going to go up to this triple top. I don't know if we'll do it on this first leg up or if we'll pull back. I think we're going to pull back here before we go up there. But every bar that we add to the trend makes it more likely that we're going to go up there without pulling back first. Weekly chart, we had 6 consecutive bull bars. So far this week, it's the 7th. I still think this week is going to close below its open. We have 4 days left. I'm not here on Thursday and Friday. I'll be speaking in Florida. However, at this moment, I think we'll probably get a bear body on the weekly chart. Simply because 6 consecutive bull bars is unusual, and 7 is even more unusual. Look at this incredible rally that we had in 2018. How many times do we have 7 consecutive bull bars? Here we had 7. If that might be a little bull bar there. But when you get too many bull bars, the stops for the bulls are too far below, and traders want to reduce risk. And one way to do it is taking profits. Then you get a few weeks sideways to down, which is what I think we will get. We had a bear channel on Friday, bear channel bull flag. We broke above it, and then we ended up with an expanding triangle on the open. It started over here, so up, more up, more down, and the bears tried to continue the expanding triangle here, but they could not trigger the sell below that or below that, and we just kept working up on a small pullback bull trend. The bears tried to get a reversal here, but probably buyers below 20 gap bar bulls. They've been buying above the moving average for 30 bars. They'll probably buy the moving average. They finally got a chance to buy it here. The bears had a double top, a slight lower high major trend reversal, and the bulls had a double bottom, and the bulls won. They got these 4 consecutive bull bars here at the end of the day, and that was enough to make traders buy into the close of the day. On the open, we had a bear channel Friday, bull breakout Friday. First bar of the day, a bear bar. So low 2, low 1, low 2, but big tail, moving average, probably buyers not far below. We had 3 consecutive bear bars, bar 3, and you can say double bottom at 78, but 3 bear bars, probably sellers above, and trading range open. Bar 5, not a bear body, so that's good follow through, but still a trading range open. Not good enough to buy the close, not good enough to sell below. Bar 5, expanding triangle, 76, 78, but I would not sell it. Bar 6, a bear bar closing near its low. Theoretically, you could sell it as an expanding triangle, pull back in a bear trend, but I did not. And then 8, another reversal up from reverse down from the high of the day, reverse up from the low of the day. Now we have an expanding triangle and a higher low major trend reversal. Bear trend, bull breakout, higher low. But 2 big bear bars, 6, 7, tail, top of 8. A lot of bulls did not buy that. They could buy above 9, but the risk is too big, and therefore a lot of bulls did not buy above 9. The bears tried to get a sell-off on 10. They viewed 6, 7 as the start of a bear trend, and 8, 9 as a pullback from the new bear trend. But there were buyers, and it turned out there were buyers below. I would not take that sell after those 2 bull bars. And then 12, pullback from the 8, 9 bull reversal, but a bear bar. So the first stop entry buy would be above 13 or maybe 15, then 16, 17. And none of the buys was all that good. We had a high 121, probably going at least a little higher. Some bulls bought about 22, 24, closing on their highs. And then another high 127. Small pullback bull trend. The setups, the trend never looks all that strong. So, you're constantly being asked to buy at the high in a trend that's not all that strong, but it's an okay swing. The bears tried to get different wedge tops, different ways to draw it, 26 and 29. My general rule is if the channel is really tight, I don't like to sell below good-looking sell signal bars because there probably are buyers not far below. So I usually wait for 2 or 3 bear bars or for the market to start to go sideways before selling. The market did go a little bit sideways, 35, so some bears sold that, and they got a couple legs down. I thought we were going to get down to the moving average. Then 41, it turned up, and we did not touch the moving average. So either it's more tight trading range, or the market's telling us the bulls are very aggressive, very eager, and it turned out they were very eager. 50 or 50, same thing. No good stop entry trades for the bears up here. Tight channel, no good. Tight channel here, you could try it for a scalp. Up here, no short. Up here, really not a good short. None of this is very good stop entry shorting. And for the bulls, we're above the moving average. They'll buy the moving average. They'll buy below the moving average. They'll buy pullbacks. But a lot of them, there were problems with a lot of the buys. 21 followed a pretty good bear bar, and it still might be the top of trading range. 24 better. 27 a doji after a bear bar. 30 looks like we're forming a wedge. 1, 2, 3. So maybe not much higher. And I think 30 was also a 5-tick trap. So even though you had a bull bar closing near its high, and again 33, if you did not use a wide stop, you wouldn't end up with a loss. 41, we have a little micro double bottom. 37, 41, but you're being forced to buy right at the top of the trend. II 45 for a bear bar, probably sellers above, and then 50, you're reversing 48, pull back to the moving average, but tight trading range for about 6 or 7 bars, and even more for about 20 bars. So swing only, not scalp. Buying about 52, surprise, probably going at least a little higher, same 54, but 54, I think it was another 5-tick trap. Then here, high 158, but we're going to hit the moving average. We got twice, close to it twice. The third time, we probably will get there, and wish we did 64. But tight channel, so traders did not buy 65. 66, 68, a double bottom 64, a high 2 if you want to call it that, at the moving average. But I think we're probably going to get one more leg down. This looks like a pullback from this tight bear channel. And then here we got a small wedge and small second leg down, 72, 73. The bears could not get a big enough bar. Theoretically, the bulls buy again about 74 or 75, but tight trading range late in the day, probably not going a lot higher. So there were problems with a lot of the trades, and I ended up taking fewer trades than I like to take, but or certainly fewer stop order trades. I did take some limit order trades, but not a lot of good trades for stop order traders. For buy the close, sell the close, I would not buy the 4 close. I would not sell the 7 close. We've been reversing since the middle of yesterday. And the market's still searching for direction here. Then we got the 4 bull bars, 15, 16, consecutive bull bars, 15, 16 also. We might be trying to get a breakout. And then 19, it broke above the 18 bar range, and it broke far enough above so that I think we're always in long, and I think we'll either be in a trading range or a small pullback bull trend. And it turned out we were in a small pullback bull trend, but not really good by the close. We're not getting consecutive big bull trend bars. 52, surprise up, probably a little bit more up. Well, 78 for that matter is a surprise bar up, but I'm not going to buy the close at the end of the day. Too much chance of risk. Limit orders, there were a lot of traditional type of limit orders early on. Big tail on 1, bull spot below. Tight trading range, they sold above 78. I think it's tough to buy below 2 after those 2 big bear bars. Below 10, tough to buy that. The 8 high, I'm not going to sell it. Too low in a trading range. I thought the first reasonable stop. The first reasonable limit order trade was the 14 low, and then I thought 26 was a high probability buy. At that point, we had, I think, a 13 bar, or yeah, I think it was, maybe it was 11 bar. But anyway, a lot of bars in a micro channel, and bulls will buy the first pullback type bull channel, room to the measured move target. 29 fewer bulls would buy that. And same with, well, 33 they might buy. It's a bull bar. 34 wedge, probably pulling back to the moving average soon. Not a good limit order buy. 35 low. Bears might sell 37. It's not 3 consecutive bear bars, but it's not a bull body. So some bears will sell 37 high. Bulls, they might buy 47 low, a bull bar, and 7 bar bull micro channel. And up here, bears might sell 54 high, might sell 60 high. Bulls, I would not buy 57 low. I thought it was a buy climax, and we would pull back for 5 or 10 bars, get closer to the moving average. And then here, some bears sold above things, above 64. And then you had limit order bears selling on the way up, selling above 20, selling above 21, 23, above 26, above 29, and also above 35. Some bears sold above 47. I would not. And the bulls trapped them. They got a breakout, and the gap stayed open. 64 did not fall below 47 high. Up here, end of the day, looks like an exhaustive buy climax. The bulls might get a small second leg up, but I still think this week we're going to reverse and close below the open of the week. So on Friday, I think the close will be below today's open. Suppose Wednesday and Thursday are big, or Tuesday and Wednesday are big bull days. Well, then I would change my mind, but I'm not going to be trading on Thursday or Friday. You got to move the GoToWebinar toolbar. So for me, this is kind of like the Super Bowl yesterday, kind of a boring thing. I like the Super Bowl. I've seen every Super Bowl, and yesterday was, I thought, one of the least interesting ones. Anyway, back to the questions. Question about yesterday. This is the same kind of thing as, say, strong sell-off, wedge bear flag, expect at least a little bit more down. We got a lot more down. And today, sell-off, probably wedge bear flag, expect second leg down. Anyway, question about yesterday. Okay, question. Yesterday's 44 high was a magnet on the way up today. Yes, spike, pullback channel. So the top of the channel, the start of the channel is always a magnet. You expect spike, pullback channel. You have a bull breakout above the bear channel, and then the market enter a trading range. And the market typically tries to test the top of the channel, which we did. Okay, back to the question. Okay, here's the top of the channel. We have another spike pullback bigger channel, so that high is also a magnet. Yesterday's high is always a magnet. Okay, back to the question. Try to keep the questions kind of short, because if they're long, they have a lot of parts. Everybody's tired, and it's hard for everybody to follow all the parts. Okay, back to the question. Yesterday's 44 high was a magnet. Today's 19 was vacuumed up to the 44 high. That's that bull bar. Well, and also broke above the 18 bar range. Could you please explain why the breakout of the opening range was likely instead of a second leg up in developing trading range? Okay. Could you explain why the breakout of the opening range was likely instead of a second leg trap, first being 8-9, and developing a trading range, especially with the bad follow through after 20? Okay. The question has a lot. That sentence has a lot of little pieces to it, and it's hard to follow. Certainly hard to follow as I'm trying to read the different pieces. But I think what he's saying is, we have a bear trend, you expect a bear channel, you expect a test to the top in a trading range. And I think what he's saying is, why was bar 19 not a second leg trap? Okay, so we're testing the key price, and it's a second leg up. We have a weak rally. You can argue low 2 instead of a bear breakout below the bear flag. We got a bull breakout above on bar 19. You can see 20, two things about 20. It did not close on its low, so it's not a strong sell signal. And more importantly, 21 did not go below the 20 low. If it had, I wouldn't have called it a second leg trap. I would have called it more of a wedge. 1, 2, 3, spike, pull back 2, pull back 3, or 1, pause, 2, pause, 3. But it would also be a second leg trap, a failed breakout above the day's high. What I said at the time was, that was a bull bar breaking above the 18 bar range and closing above the 18 bar range. But what's special about it, what's good for the bulls, is it's closing fairly far above the 18 bar range, the bar 7 high. And that made it more likely that either we were going to go sideways or up, and it turned out we went up. It's not all that climactic. If it was bigger, and if 20 was an inside bar, 20 went above 19, but if it was an inside bar closing on its low, then I would start, I would have used the term second leg trap, but it was not big enough, and 20 went above 19. Second leg traps, that usually is not what happens, and had the tail below. So I thought we were going to go sideways or up, but not a lot up, but possible that we'd end up on a small pullback bull trend. So all through here, I thought trending trading range day, and then we get the surprise bar up 52, and it looks like at that point that the small pullback bull trend is going to last longer. Now we take a look at Kirkland Lake Gold. Where should the protective stop be? Yeah, when you see something like that, GLD is the same thing. A whole bunch of gold stocks, GOLD, same thing. Here's GOLD, used to be American Barrick, and Kirkland Gold, same thing. Okay, you know where the stop belongs. When you look at that, you say, oh no, I could put the stop here, but if we pull back, we're probably going down to the most recent buy climax low. So if I'm holding long, my stop is either here or here. And you say, wait a minute, there's no way a $32 stock, I'm going to risk $7 on a $32 stock. And it's risking 25%. I'm not risking 25% on a trade. So you're not the only one who's asking that question. So if let's say you work for a hedge fund, and you're the risk manager, and you know 5 of your traders are long Kirkland Lake Gold. What are you going to tell them? You're going to tell them, hey guy, you can't put your stop down here. You cannot put your stop down here. You're risking too much. You have too much risk. The money's in our account. I don't care if you bought it here or if you bought it here, or even if you bought it here, your risk is here. So you're risking, 20, 25%, and you cannot risk that much. You have to take profits. And that always happens with buy climax. The risk managers are telling the traders you got to take profits. And therefore, we're probably going to pull back pretty soon. So, I think it's okay to have a stop down here or here, a catastrophic stop, but do not plan to let it get hit. And then if the market starts to possibly top out, get out below a bear bar closing near a slope. But if I'm long right here, my stop is down here, and it's possibly one bad day can do it, but that would be really unlikely. Maybe on earnings, I don't know when the earnings comes out. However, I would start looking to take partial profits or full profits if we start to go sideways, and if we get a bear bar closing near a slope. So if we get something like that, I'd get out below that bear bar and then wait for a second buy signal, either above here or above any of these bars before getting long again. I'm going to move the toolbar around. Question: as a stop order trader, I have trouble making money in channels. Yes, that is absolutely true. Okay, question: I bought during 19, good, but sold below 26, okay, and above 41, but I scalped. I use a 10-point stop and scale in if necessary. How do I make money in channels on a day like today? I think a day like today is really difficult for a stop entry trader. If you're a Walmart trader, you can do it. I talk about that every now and then. You see a trade, it doesn't look all that good. You know where the stop goes. You take the trade, put the stop, and then go to Walmart and come back in a couple hours. So you buy above 21, buy above 24, buy above 27, put a stop down here, and come back in a couple hours and see if you can tighten the stop. But you're right, this is a small pullback bull trend day. You get maybe a couple of days like this a month, but a small pullback bull trend day is difficult for stock traders because it looks like a bull leg and a trading range. And it looked like a bull leg and a trading range here. At this point, it was more likely we were going to enter a trading range. Instead, it just kept going up and up and up. So that makes it hard. Okay, back to the question. I bought above 19. That's good. But sold below 26. That's okay. I think that's reasonable to get out there. And then you got to get long again. And it says it's above 41. I don't know if you sold above 41 or bought above 41. I think you buy above 41 and you get out below 48. I think that's reasonable as well. And that's one of the problems with channels. The market tends to come back and test logical stop entry locations, and it's easy to get stopped out unless you use a wide stop. When I see the market in the channel, I tend to scalp much more. Obviously, if you just bought above 9 or above 15, put a stop below 8, and came back a couple hours later, you do extremely well. But this kind of a day happens only a couple times a month. And when the market is doing this, what's more likely, trading range or continuation? Trading range is more likely, so it's more likely that we're going to go sideways here, and the less likely thing happened. And I talk about this all the time. When a low probability event happens, usually it has very good risk reward, which means not much risk and very big reward. And the opposite is also true. If you have a high probability event, you're probably not going to make much money, and your risk is probably more than what you want. But I hear what you're saying. If you take any of these buys, do you use a tight stop or do you use a wide stop? And if you're a swing trader, you use the wide stop. You buy above 19, you put a stop below 12, and you wait until there's a credible sell. Tight bull channel 29, tight bull channel sell signal mark 26. Those are not good enough sells. So if I bought above 19 and I was a swing and I'm trading it like a swing, I would either stay long until we get maybe 2 or 3 consecutive bear bars, or if I get out, I'd get right back in. And as a swing trader, and let's say you bought above 19, I think best choice is just to hold, put a stop down here, and then after it goes up a little bit, look for some reason to tighten the stop. The first reversal down, any of these first reversals down, will be minor. And once you go to a new high, then you can put a stop below that low, the low of that first reversal down. And I think that's the ideal way to swing trade it. But the reality is, excuse me, I'm losing my voice. A lot of traders just keep getting out and getting back in, getting out back, getting back in, and they end up making less money than somebody who just buys, uses a swing stop, goes to Walmart and comes back in a couple hours. But that's because of the nature of this day. Most days are not this way. Most days, either you buy and it keeps going up without the bear bars and you make a lot of money, or you buy and it gets the bear bars and you get reversals and you're happy that you did get out. Could you please talk briefly about initial versus actual risk. I understand that if a stop is too far away, that is not the actual risk. But if the stop is reasonably placed, it could have been hit. So for me, that is the actual risk. Actual risk is what you actually risk. So let's say you let's say you bought on a stop above 9 and you got filled, right? And you put your stop below 8. Your initial risk is from your entry price above 9 to your stop below 8. And let's say you held and it came down to the 12 low and started going up again. Then you know you actually had your risk from your entry price, 1 tick above 9, to 1 tick below 12. And you don't know what your actual risk is until the market starts going back up, like above your original price after the pullback. So in that particular case, your actual risk was fairly big, almost as big as your initial risk. But that's how I look at it. Wherever I enter, I look at where my initial risk is. I wait for the pullback if I'm staying long, and then I wait for a new high. And at that point, I knew how much I actually had to risk. I had to risk 1 tick below 12. So you just count it up, whatever that is, 5 points. You had to risk 5 points plus 1 tick. And that's everybody knows initial risk, but everybody has a different initial risk, but everybody has the same actual risk. No matter where you bought, once it goes up to a new high, you had to risk to 1 tick below that low. So if you bought in here and it goes up to a new high, your actual risk was 1 tick below the 40 low, even though your initial risk may have been here or here or here. So I hope that makes sense. Okay, so we ended the day with a buy climax and a reversal. The bulls have bought the 78 breakout. What do? Right? If they did not scalp out, they got stopped out below 79, or they exited on the end of the day, probably with break even or loss. And the bulls have bought the close 78 or above 78, ended up giving back 3 points on the day. So that's an example of how dangerous it was to treat this as a buy the close finish starting too late in the day. Okay, hope everybody has a good night.